Let's talk about something you've probably never wondered about, but maybe you should. What's the connection between the financial world in Tokyo and your 401k? Well, there's a massive under the radar financial shift happening right now that connects them directly. And yeah, it could have a very real impact on your retirement savings. So let's break it all down. It sounds a little crazy, doesn't it? I mean, what on earth could an election in Japan possibly have to do with your personal portfolio? Stick with me, because by the end of this, you're going to see this straight line that connects a vote over there to the numbers you see on your statements right here. All right, to get what's happening now, we have to rewind a bit. We need to look at this incredible financial engine that's been humming along in the background for decades, quietly pumping literally trillions of dollars into markets all over the world. It's a thing called the carry trade. You know, the idea here is actually super simple. For 30 years, Japan has been fighting off economic stagnation, and in the process, it basically became the land of free money. Just imagine you could borrow a ton of cash at 0% interest and then turn around and invest it in something that pays you 5%. That gap, that's all profit, and you made it using someone else's money. That, in a nutshell, is the Japanese carry trade. So here's how it actually plays out. It's a simple three-step dance. Step 1. A big investor in Japan borrows a mountain of yen at almost zero interest. Step 2, they immediately swap all that yen for US dollars. And then, step 3, they take those dollars and plow them into US assets. We're talking stocks, government bonds, real estate, you name it. And they just sit back and collect the much higher returns. And let's be really clear here, we are not talking about chump change. We are talking about trillions of dollars. This massive, decades-long river of cash flowing from Japan has been like a giant tailwind for the US market. It's helped push up the price of pretty much everything. It's one of the key, invisible reasons your 401k has probably done so well for so long. But what happens when that free money machine suddenly starts to sputter and even threatens to go into reverse? Well, that is exactly what we're starting to see right now. This system that's been in place for 30 years is changing, and it is changing fast. And it all kicked off with a political earthquake. See, Japan elected a new prime minister, Sanae Takaichi, and she didn't just win, she won with a 2/3 supermajority. Now, what that means is she has almost unlimited power to push through her agenda, which involves a ton of new government spending and stimulus. And the effect was immediate. I mean, just look at this. For 30 years, interest rates in Japan were basically zero. Sometimes they were even negative. But right after that election, they shot up to 2.3%. That's a 27-year high. For a financial system that was built on the idea of zero-cost money, a shift like this is absolutely seismic. So here's the critical part. As Japan's rates go up, that free profit from the carry trade, it just vanishes. And there's a great line that sums up what happens next. When the math stops working, investors don't just stop buying US assets, they start selling them. They have to. They've got to get that money back to Japan to pay off the loans that are suddenly way more expensive. Okay, so this is where we finally connect all the dots and answer that first question. How does this giant financial unwind in Tokyo actually send ripples all the way into your retirement account? Well, it all comes down to a simple, powerful domino effect. The very first domino to fall is the selling. To get out of these carry trades, Japanese investors have to sell off all their US stuff. And we are talking about a gargantuan amount of assets, including their huge stash of US government debt, which is something like $1.4 trillion. The second domino is just basic market physics. When one of the biggest owners of US bonds starts dumping them on the market, that flood of supply pushes bond prices down. And here's the crucial part. Bond prices and interest rates are on a seesaw. When bond prices go down, their yields, the interest rate they pay, have to go up to find new buyers. Now for the third domino, which brings us into the real economy. Higher interest rates across the US mean it's suddenly more expensive for companies to borrow money. And they borrow for everything, new factories, payroll, you name it. And higher borrowing costs, well, they cut directly into a company's profits. And here we are, the final link in the chain, the last domino. Lower corporate profits almost always lead to lower stock prices. And since your 401k and other retirement accounts are probably filled with those very same stocks, their value goes down. And just like that, a political decision made in Tokyo has shown up, clear as day, in your portfolio. Okay, so understanding the risk is one thing. But the real key is having a framework for how to think about it. This isn't about running for the hills, it's about having a clear, rational way to navigate what could be some pretty choppy waters. Professionals tend to think about this stuff with a pretty simple three-step framework. First, you follow the money by watching a couple of key signals. Second, you identify the pressure points in your own portfolio, like what's most vulnerable if rates keep rising. And third, and this is absolutely the most important part, you automate your strategy before your emotions get a chance to hijack your decisions. So if you want to follow the money, there are really just two big flashing signals to keep an eye on. First, Japanese interest rates. If they keep climbing, the pressure to unwind this whole trade just gets stronger and stronger. And second, the Japanese yen. If you see the yen start getting stronger against the dollar, that's a huge sign that capital is rushing back home to Japan. And this really gets to the most important takeaway of all. As humans, our brains are just wired badly for making smart financial decisions when we're in a panic. The time to think, the time to plan, the time to set your rules is right now while things are relatively calm, not when the scary headlines are flashing and the markets are going wild. The signals are all there. Japanese interest rates are at a 27-year high. A new government has the power and the mandate to spend. And that trillion-dollar trade that's been propping up U.S. markets for decades, it's seriously at risk. The financial tide is definitely shifting. The only real question left is, will you be positioned for it, or will you be blindsided by it?